When it comes to choosing investments, there are many options available for you. You can invest in stocks, bonds, real estate, and a variety of other assets. However, many people don't know about the different types of funds that are available for you. In today's video, we will compare mutual funds, ETFs, and index funds. This way, you'll have a better idea on how to get started. But first, welcome back to the Be Sooner Fire Journey channel. My wife Sean and I started the path to building wealth and taking control of our finances in our early 20s. We love sharing ways to make, save, and invest money. So if you find today's video helpful, please give that lonely like button some love and subscribe for more on our financial freedom journey. So what are mutual funds? A mutual fund is an investment vehicle that consists of a pool of funds. The funds are from many investors who invest in securities such as stocks, bonds, and other assets. Professional money managers help manage mutual funds. Their purpose is to allocate the fund's assets and attempt to produce capital gains or income for the fund investors. To start investing, you will need a brokerage account or 401k account. This is because you cannot trade them on the open stock market. The money managers receive a management fee, which is typically a percent of the fund's assets. Let's talk about mutual funds, the advantages and disadvantages. The main advantage of investing in mutual funds is that they provide small investors with access to professionally managed portfolios of securities that would be otherwise unavailable to them. This can be helpful if you don't have time or expertise to manage your own investments. Another advantage is that mutual funds are relatively easy to buy and sell, and they offer liquidity, meaning that you can cash out your investment at any time without having to sell the underlying securities. A key difference between mutual funds and ETFs and index funds is that they can be bought or traded once the market closes for the day instead of during open market or extended market hours. Mutual funds come with several risks, however. One is that the performance of the funds depends on the skill of the fund manager. Even the best managers can have a bad year. Another risk is that mutual funds are subject to the overall market performance, meaning that their value will go up and down with the stock market. Mutual fund managers will work to reduce these risks by diversifying the fund's holdings. Before investing in a mutual fund, be sure to research the fund's objectives, fees, and track record. You should also consider your own investment goals and risk tolerance. With thousands of mutual funds to choose from, there's one that could be right for you. Now, what is an ETF, or exchange traded fund? An ETF is an investment vehicle that consists of a basket of assets such as stocks, bonds, or commodities. You can buy and sell ETFs like regular stocks and trade them on stock exchanges. One advantage of ETFs is that they offer investors exposure to a broader range of asset classes in a single investment. For example, an ETF that tracks the S&P 500 index provides exposure to 500 large cap US stocks. This is beneficial because it allows investors to diversify their portfolios without having to purchase individual stocks. Market investors enjoy ETFs due to their low costs, tax efficiency, and flexibility. Their popularity has exploded in recent years, with more and more people wanting to manage their investments by themselves. However, ETFs do come with their set of risks. For example, because ETFs are traded on stock exchanges, their prices are subject to market fluctuations. Additionally, some ETFs are more volatile than others. It's important to do your research and understand the risks before investing in an ETF. If considering adding ETFs to your investment portfolio, it's important to understand how they work and the risks involved. With a little research, you can make an informed decision about whether or not ETFs are right for you. Now, what are index funds? Index funds are a type of investment fund that tracks a specific market index, such as the S&P 500. These types of funds are passively managed, which means they aim to track the performance of the underlying index. Index funds are great because they have low fees than actively managed mutual funds, and they can be a good choice for investors who want to invest in a broad market index. You can buy and sell them like other types of investment funds, and you can hold them in both taxable and tax advantage accounts. When you buy an index fund, you're buying shares of the fund itself, not in the underlying assets such as stocks or bonds that make up the index. The value of your investment in an index fund will rise and fall with the value of the underlying index. You may want to add index funds as part of your broader investment strategy, such as asset allocation or dollar cost averaging, comparing the similarities and differences. If you want to invest in an entire sector, index funds may be the right thing to do for you. You can buy an index fund that tracks the total market, or you can invest in the S&P 500, which gives you exposure to 500 large cap US stocks without having to purchase every individual stock. So ETFs are similar to index funds because they share that feature of being able to track an index or sector. For example, ARK ETFs tracks innovation industries such as automation and artificial intelligence. Both ETFs and index funds have the added benefit of being traded on stock exchanges, so investors do not have to go to a financial advisor or a banker like mutual funds. However, ETFs may have more volatility than index funds because they are traded like stocks. Additionally, some ETFs are more volatile than others. It's important to do that research and understand the risks before investing in an ETF. Positions within an ETF are traded throughout the day as the market fluctuates, which can result in investors seeing large changes in their investments. Index funds are passively managed, which means they aim to track the performance of the underlying index. ETFs, on the other hand, are actively managed. This means that a team of professionals is constantly making decisions about which stocks to buy and sell to outperform the market. Because of this, ETFs typically have higher fees than index funds. When it comes to risks, ETFs, index funds, and mutual funds have the potential to lose money if the underlying asset declines in value. However, with a mutual fund, you may not panic and sell, as your advisor will be making the decisions about when to buy and sell. With an ETF or index fund, you may be more tempted to sell if the market starts to decline, which could lead to losses. The main difference between ETFs and mutual funds is that ETFs are not actively managed by money managers. Instead, they track a specific index such as the S&P 500. This means that ETFs have lower management fees than mutual funds. Thus, there is no need to pay a professional money manager to manage the fund. So to wrap things up, the similarities of all three are that they allow investors to gain exposure to the stock market in a diversified way. They differ in the amount of control and fees that each incur. So mutual funds versus ETFs versus index funds, which is the best? A strong advantage of ETFs is that they offer greater transparency than mutual funds. This is because you know exactly what the fund owns at all times. ETFs can contain more tax advantages than mutual funds, which is one of their many advantages. This is because ETFs are not subject to the same tax rule as mutual funds. For example, when a mutual fund realizes a capital gain, it must distribute the gain to its shareholders, which are then subject to capital gains tax. ETFs, on the other hand, do not require the distribution of gains to shareholders. This makes them more attractive to investors who are looking to minimize their tax liability. Another advantage of ETFs is that they tend to be more cost-effective than traditional mutual funds. Mutual fund fees can eat into your investment returns, but ETFs typically have lower fees because you do not need to actively manage them. A mutual fund management fee can be up to several percent points higher. This may not seem like a big difference, but over long term, the lower fees can add up to significant savings. So ultimately, it depends on what you're looking for as an investor. So if you're looking to track a whole index and want those lower costs, then index funds are a great choice. If you're looking for a more professionally managed portfolio and are willing to pay that higher fee, then a mutual fund may be a better choice. If you're looking for something in between, then an ETF may be the right investment for you. Self-awareness is key when it comes to investing. Consider your risk tolerance, investment goals, and time horizons when making any decisions. Remember, there is no one-size-fits-all answer when it comes to investing. The most important thing is that you invest in something that you're comfortable with and that aligns with your financial goals long term. Do your research and consult with a financial advisor if needed to figure out which investments are right for you. Now, what are some of your favorite investments and why? Make sure to drop a comment below, and please make sure to subscribe to not miss out on more content to come.